You probably came across this video because you're looking for ways to invest in wind energy, and purchasing stock in a company that builds wind turbines is certainly one way to get exposure. And when we talk about wind turbines, there's actually a whole lot to it. So here you can see the various components of a wind turbine, which consists of the blades, the rotor, and the nacelle, which is the enclosure that houses all the different components. Here in this picture, you can see just how large one is. That's a nacelle built by General Electric, which is one of the top turbine manufacturers. Now, when we look at the wind thesis, this is a chart taken from, I believe it's Solar Edge, and it shows what renewable energy will look like in 2050. And you can see here that both wind and solar are expected to grow significantly, with solar being the dominant form of energy by 2050. So whilst wind isn't growing as fast as solar is, it certainly has momentum. And if you spend any time in the Columbia River Gorge, you would see a lot of these trucks driving that highway. And this is the pillar for a wind turbine to sit atop of. And you'll also have the large blades as well. Now, when we look at the growth of wind energy, it's largely come, at least in 2020, from two countries, the United States and China, both of which saw record levels of installations, which they say resulted from developers rushing construction to meet support scheme deadlines. So there we see elements of subsidies, and we can talk about whether or not renewable energy is competitive with fossil energy, but the truth is, according to Lazard's analysis, what's called a levelized cost of energy, wind is quite competitive without subsidies. So in 2020, the amount of wind capacity that was installed doubled over 2019. Again, 80% of that coming from United States and China. So when we look at the manufacturers of wind turbines, we'd expect to see representatives from both those countries, although about half are from China and the rest are from other various places. Now here's a picture of a wind turbine blade, and these are quite bulky to transport, but they still manage to drive them around the highways and to assemble these giant wind turbines using large cranes. Now, looking again at the installation over time, you can see here that China has just been installing like mad, and the rest of the world not so much. So mainly that helps explain why you have so many Chinese turbine manufacturers, because they have a lot of domestic demand. Now here's a chart from Lazard that I talked about earlier, which looks at the levelized cost of energy. You can see at the top there how utility scale solar is quite competitive, getting close to the one on the bottom, which is a gas combined cycle, which appears to be the most efficient after wind. And of course, you have a breadth here of efficiency. For example, wind from 26 to 54, and those are based on different variables. And of course, you need to take into account things like storage. The wind doesn't blow all the time. So certainly renewables are becoming far more economically viable, and as they do, demand for renewable energy increases. And we look at the biggest wind turbine manufacturers. For 3 years running, it's been 5 companies that are in those top 5 slots: Vestas, Goldwind, Siemens Gamesa, Envision, and General Electric. So we can be fairly certain that if we're looking to invest in a leader, it's going to be one of those 5 names. So when we look at the top 5 there, GE plans to spin out their energy company as a separately traded entity in early 2024. So up until then, there's nothing to invest in because General Electric is a conglomerate. So though that's scratched off the list. Then you have Envision is privately held, so we can't invest in them either. Now, of the remaining names that you see here, Vestas, Siemens, and Goldwind, Siemens plans to delist later this year. That's a rather complex corporate event that's happening, but Siemens, as the parent company owns a certain percentage of Siemens Energy, which is going to acquire the remaining shares of Siemens Gamesa and delist that later this year. So provided that happens, there won't be an option there. So really, we're left looking at Vestas and Goldwind. Now, we've talked about the dangers of Chinese stocks. Those extend beyond risky VI structures, which most Chinese tech firms use. And Goldwind actually uses a H share. So that removes the VI structure risk, which is great. But if you look at what they do, over 92% of their revenues come from China. So you're investing in a company with the majority of its exposure coming from a single country. And when you start to dig into their financials, you see they're unaudited and provided in a different currency. It becomes very difficult to monitor the company over time. So Goldwind wouldn't be a company that we would look at. However, Vestas is one that we have looked at before, and it's actually sitting in our catalog right now and our tech stock report as alike. And we noted before that they're the market leader. That's by market cap and revenues. But there's a problem there, which is that their gross margins have been becoming compressed over time. From 2018 until now, they've fallen from 16% to 10% on an annual basis. And if you look at the chart here, you can see that on a quarterly basis, they're becoming very compressed. So last quarter saw a gross margin of just 2.9%. Well, if that goes to negative, that means they're not able to sell a profitable product. And there's really two components of what they do. More recently, this problem has accelerated, and they're largely citing cost inflation and supply chain disruptions. And when you look at the overall quarterly revenues over time, you can see that the problem has gotten significantly worse in the first quarter of this year, where they've moved into a negative margin, net margin or EBITDA margin, and their revenues have fallen as well. So when we look at the two components, the two segments that they service. They have power solutions that's building wind turbines, and services. And you can see here, quite interesting, how the margins differ. So services, of course, has a much higher margin, which has been consistently declining over time. And more recently, they cited lower profitability on certain projects in USA and Africa. Well, that trend has been going downwards, which isn't good. And when you blend these, you get that gross margin that we talked about earlier at a company-wide level. On the left here, you see power solutions. And again, the negative margins there are attributed to these cost inflations and supply chain disruptions, which result in increased costs and lower revenue, which is creating a problem for the company. When we talk about servicing turbines, this is a rather remarkable picture. Some of you may have seen it, of two engineers embracing on top a wind turbine that's on fire, and both these gentlemen ended up perishing on their way down. And it goes to show just how dangerous these jobs can be when you're servicing wind turbines. This is why you hear a lot of feminists argue for equality in the wind turbine servicing industry, where 96% of individuals are male. So when we look at the additional two metrics on this slide, these are important to pay attention to. And the first here is this lost production factor. So they'll provide this every quarter, and you can see how it's gone up sharply. And what this refers to is the loss of production, what it says on the tin. So at 100%, that means that you're getting 100% utilization. But if you're getting a 5% loss production factor, that's 95% utilization, more or less. So you can see that as this number goes up, that means that the utilization is going down, which is bad, because in particular arrangements, there are probably service level agreements tied to this metric. And they also include here warranty provisions made and consumed. So when you have a warranty on a blade and something goes wrong with that, then you need to fix it, and that comes out of your pocket. So you can see here that the cost inflation and logistics challenges for repair and upgrade of existing cases have caused their warranty provisions to go up. And you can see in blue, that's what's consumed, and gray, that's what's made. So obviously gray has to be more than blue so that they're provisioning enough to cover their warranty. So this company is operating very tightly, as a business. But one of the good things to note here is the distribution of revenues. They have very strong geographical diversification. You can see here EMEA has 52% of revenues, APAC 13, Americas 35. So as opposed to Goldwind, Vestas has a great diversification of revenues across various countries. So just to conclude, seems like there's a lot of downside that's possible here, not a lot of upside. So they're going to see increased pricing pressure from Chinese firms that are dabbling and probably able to build things a lot cheaper. There's constant margin pressures over time. The trend is certainly not their friend, and those were likely to get worse. There's better ways to play renewable energy, we believe, one of those being the largest holding in our own portfolio, which is NextEra Energy Resources, the world's largest generator of wind energy. So please put your comments in the comment section. Make sure to subscribe to our channel, and thanks for taking the time to watch this today.